Imagine getting a text message that wipes out your whole net worth. You check your trading app, praying for a glitch. The reality is worse. Your life savings are gone, and you owe the bank a fortune. That scenario hit 300,000 young South Korean investors in a matter of days. An automated system forcibly liquidated their accounts, wiping out $250 billion. The crash happened because the market became driven by two explosive, intersecting forces: an obsession with artificial intelligence and a massive accumulation of retail debt. A machine built on leverage broke, bypassing human panic and executing a mathematical destruction that is now sending shockwaves toward the U.S. By early 2026, the entire South Korean financial system pivoted. Local markets became concentrated on artificial intelligence and the massive computing power it requires. Two domestic champions, Samsung and SK Hynix, hold a near-global monopoly on high-bandwidth memory, or HBM chips, the hardware necessary to run complex AI models. This diagram represents the Kospi Index. As trillions flooded in, Samsung and SK Hynix expanded to make up half of the South Korean exchange. A standard index fund lost its inherent diversification, becoming a high-risk bet on a single industry. The market shifted from a broad national index into a concentrated bet. Diversification vanished, replaced by two companies holding the stability of the entire exchange. This intense wealth shift attracted a specific demographic. Young South Koreans in their 20s and 30s face a tough job market and unaffordable housing. The stock market looked like their only reliable escape path. Government officials saw domestic cash starting to flow overseas into American tech stocks. To keep that money inside the country, regulators legalized a volatile product, the single stock leveraged fund. These funds tied directly to local champions like Samsung, promising to double a trader's daily profits. College students and young professionals maxed out their credit, using phantom money to buy in. Regulators left 30 trillion won of margin debt concentrated within these funds, consolidating the country's collective wealth into a single high-leverage entry point. The initial stressor came from the outside. Foreign institutions needed rapid liquidity to buy into the $75 billion SpaceX IPO. To secure quick cash, global asset managers began selling their Korean tech stocks. A month later, SK Hynix made a move. The company listed directly on the Nasdaq, raising over $26 billion in America. This move gave U.S. investors direct access in U.S. dollars, bypassing the exchange in Seoul. Trillions of dollars from passive global funds immediately rotated out of the Kospi Index and into the Nasdaq. The foundation of foreign institutional capital evaporated overnight, precisely at the moment domestic retail leverage reached record highs. A traditional index fund buys and holds actual shares. A single stock leveraged fund operates by making massive bets with global banks, contractually guaranteeing double the daily profit of a specific company. Funds must mathematically rebalance daily. If the stock drops, it loses double. To fix the balance, algorithms mechanically force the fund to dump shares. One SK Hynix derivative grew to $13 billion, its balancing act consuming the company's trading volume. The stock price detached from the business health of SK Hynix and AI demand. It was now controlled by an automated mathematical algorithm. When foreign investors left for the Nasdaq, a natural price tip triggered the fund's automated rules. Millions of shares were instantly dumped on the market. Faster, more urgent drove prices down, triggering immediate margin calls. Banks seized accounts for borrowed money, which triggered an even more aggressive wave of algorithmic dumping. On the morning of July 13th, the market crashed so violently that the Korea Exchange stepped in. They tripped 7 consecutive circuit breakers to halt the entire system. Human emotion did not dictate this Black Monday. The automated rules of a heavily leveraged debt machine executed its own destruction. By the end of the week, over 300,000 retail accounts were wiped out. A generation of young investors lost their savings and were left holding the remaining debt. The South Korean government hit the panic button. Regulators at the Financial Services Commission fast-tracked rules to pause all new leveraged funds and demanded a $20,000 minimum cash deposit from traders just to participate. As the local Korean market burned, billions of dollars rotated back into the American stock market. This happened as Federal Reserve Chair Kevin Warsh maintained a strict monetary policy. High interest rates are actively draining the global system of cheap debt. The end of easy money exposed the brittle, highly leveraged design inside the Korean market. The structural vulnerabilities exposed in South Korea mirror the state of the US market, where a tiny group of 7 tech giants carries the weight of the entire economy. The dynamic inside the US AI trade is fragile. Massive hyperscaler companies act as the primary buyers, effectively serving as a funding trade for the semiconductor companies selling the chips back to them. In South Korea, the intersection of extreme concentration and leveraged debt resulted in an automated collapse. US tech companies are now under pressure to prove real profits fast or risk following a similar trajectory.